While the collective investment schemes industry attracted net inflows of 4 billion rand in the second quarter, it's been the lowest since the end of March 2008, and bulk of that consisted of income that has been reinvested more so than anything else. ASISA highlighting that the picture would look considerably dire if you discount that money. So just how bleak a scenario are we looking at here?
Look, I mean, quite clearly the last quarter, the quarter end of June, wasn't a great one for inflows. But one must see it against the background, the context of a total 66 billion inflow for the 12 months to the end of June. Obviously, the quarter was affected by a number of issues. The outflow out of the dividend income funds and close to 10 billion disinvested from money market funds. We're not particularly perturbed about that because we believe it's corporates disinvesting out of the money market fund, and hopefully they will deploy the money within their businesses to good cause.
Well, let's get into one of those factors that you've highlighted that possibly came to bear over this second quarter in particular, and that's the impact of that recently drafted 2011 Draft Taxation Laws Amendment Bill, which indicates that the tax loophole would soon close for dividend income funds. What exactly are we looking at there, and how are investors viewing that at this stage?
It shouldn't come as any surprise to anybody. I mean, the process has been ongoing for 18 months. And I think by all parties, Treasury, SARS, the FSB and our members, it's been handled very professionally. Those funds attracted money in the past because within the then tax laws, they were completely above board and legitimate. And in terms of the discussions with National Treasury and SARS, they decided to plug some loopholes. The net effect of that is that manufactured dividends would not be tax-free anymore, but ordinary preference shares, if they held in the portfolios, would still be, obviously, income off that would be tax exempt. Now, some time back, our members contacted their investors, told them that this was about to happen, and there's been planned exit strategies and alternatives given to the investors in those particular funds. So it's no surprise, it's been an 18-month process, and obviously the outflows are as a result of this process. In total, probably around 4.3 billion.
Well, with that being the process that's happened over the past 18 months or so, and the shifts, that we're seeing taking place right now, what's been the most popular with investors in terms of, the categories that they are allocating funds to at this stage?
Which is quite a good news for us, is that there's an increasing amount of money flowing into what we would call our asset allocation funds. And I think the investors are merely taking a view there that they let the professionals make the call on the asset classes or the sectors. And that's been growing steadily. It's about 28% now of the total assets, and that's good news. And those particular sectors have performed reasonably well over any measurement period from 1 to 15 years.
What's the trend been with regards to when a fund like this does perform well? Because one would assume it's right now, with all the volatility that we've got going on in markets globally, that investors have become a little bit more risk averse, and those who find it hard to stomach all that volatility see asset allocation funds as the alternative.
Oh, absolutely. I mean, let's be quite categorical about it. The equity-based or general equity funds or equity-based unit trusts have still been the best performers. But having said that, they obviously have greater levels of volatility. So a good compromise or a good strategy has been for people to go into the asset allocation funds, where the portfolio managers of those funds would decide what exposure they want when. And the performance on those funds have far outperformed inflation and your fixed interest funds over the period, and have generated real returns for their investors.
Let's take a look at the kind of returns we're looking at here, and you can pinpoint a period that would make sense to look at right now.
Well, I mean, quite clearly, all the performance numbers are affected by the financial crisis and the stock market crash. But if one just looks at the 1 year, I mean, it's 21%, I think it was for general equity, about 14 for asset allocation, and 6% for money market funds. Over the 5-year period, obviously the gap narrows because that takes into account the crash, but on the 10-year performance numbers, it's substantially better than money market funds and substantially higher than inflation.
That on the domestic scene, Leon, when it comes to offshore focus, just how much direction or attention rather is being diverted that way?
There's about 3.4 billion invested in the 300 and odd registered foreign funds in South Africa over the quarter. About 1.2 billion of that was retail, about 2.2 billion institutional, but substantially down from the prior quarter. And the assets there are down from about 122 billion to 112 billion, mainly the result of one major fund closing down for business.
Of course, local investors who do want to indulge, in those offshore funds must comply to Reserve Bank regulations, and this would also affect their foreign capital allowance, right?
It comes from their foreign capital allowance, and it flows through funds that are registered in South Africa at the FSB. And I think if we could just mention something, it's not just a currency thing. It might look attractive to externalize because the rand's relatively strong, but you must also take into account in which markets you're going to invest and what the potential returns in those markets are, because the South African market relative to the US and the FTSE has still been one of the better performing markets in the world.